Hey everybody, in today's video, I'm going to be talking about 7 Canadian dividend ETFs to consider adding to your watch list or your stock portfolio. We're going to go through what each of these 7 dividend ETFs are, and then what kind of stocks or securities get held in each of these ETFs before going into what their dividend yields are, what their management fees are, and what my overall thoughts of each of these ETFs are. So if you like this kind of content, be sure to give this video a big thumbs up, and we're just going to jump right into it with number 1 here, which is ticker CDZ. This is the iShares Canadian Dividend Aristocrats Index in Canada. You see here in the last year, it's down about 4%. Essentially, what this fund does is it takes lots of stocks in the Canadian market that have actually had a really strong track record of increasing their dividend over time. So not only are you getting what the starting yield is, hopefully if history repeats itself, that yield will actually increase every year with dividend increases on the underlying securities. In the last 5 years, they're up about 13%. So that's not too bad considering you've also been getting a pretty nice dividend this entire way as well on an annual basis. So you're getting mostly dividend returns, but also some capital appreciation as well. Looking into a bit more of information on this ETF, you can see here the Canadian Dividend Aristocrat ETF has actually performed pretty well. If you bought in 2006 with $10,000, you'd be up at about $30,000 of value right now. They also pay a pretty nice dividend. So their total rate since inception, which taken into account was right before the Great Recession, is about 6%. So it hasn't done phenomenal, but also not the worst place that people have been putting their money. If we look at some other information about the stock here or the ETF, you can see their top holdings. A couple of things to call out. This is their top 10 holdings, only 21% of the portfolio. So they hold a lot of securities. I think about 90 they call out here. And they do have 0.6% management fees. So this is definitely on the higher end of what I like to see in terms of management fees that are going to the company in order to have all these stocks basketed together. And that's one thing you always want to watch out when buying an ETF, making sure the management fee makes sense to you. So this one's on a bit of the high side for me. But they do give you a pretty nice breakdown of different types of stocks they own. So they have some infrastructure stocks, Chartwell Retirement Residence, Great-West Lifeco, which is an insurance company, Parkland, Power Corp of Canada, lots of energy companies, lots of banks. But really, that's what the Canadian economy is when we look at it at its entirety. Lots of financial, lots of energy, nice little bit of real estate. So it's a good summary of what you'd get with a broader Canadian economy ETF, but you can kind of just get a sense here for all the different levels of exposure you get. And it's just great to see that ETFs like this, while this one in particular is a bit expensive, you can get such great diversification, not only of industry, but also yield, and you can get a good starting yield with also getting access to some of the companies that have dividend growth. So Parkland's one that's taken off this year, 3.1% starting yield, but they've actually increased their dividend for many years in a row. Manulife's another one here. You're getting a stronger starting yield of about 5%, give or take, 5.6%. But they also increase their dividend every single year over the last 5 years. So you're getting that yield, you're getting the starting yield. You're also getting companies with lower starting yields, like Aecon, I believe, was on the list with this one actually has a higher starting yield, forgive me. But I'm sure within the ETF, they also have lots of lower yields that have higher growth rates to make sure that as the years goes on, you're still getting a nice little raise year in, year out. The second ETF we're looking at here today is the Horizons Equal Weight Canadian Bank Index. So this ETF here, down about 9% on the year, holds lots of the Canadian financial stocks. So lots of people aren't sure, do I buy TD Bank? Do I buy Scotiabank? Do I buy CIBC? In this ETF, I believe they hold all of them. So you can see in the last couple years, banking, or especially the last year or so, banking's kind of been trending down with the broader economy and concerns over interest rates. But over the long term, banking has been a great industry to be in, especially the Canadian banks pretty much have an oligopoly. And sometimes you can just buy an ETF that holds all of them instead of wasting your time deciding which one you want to buy, which one you want to be overweight, underweight. You can see here the breakdown between the big banks here, pretty even. So Royal Bank has about the same size as Canadian Imperial Bank of Commerce, even though it's a much bigger company. So this isn't necessarily weighted. It's just an equal weighting across the 6 big banks in Canada to get that exposure. And looking at the stock or ETF rather here, just taking a look at their management fee, but a 0.28%, so a bit more manageable than the management fee of 0.6% on that first ETF. Still not the cheapest one that you'll find in Canada. There's lots of funds with 0.5 or sorry 0.1, 0.15% management fees, but this is a bit more digestible, 0.25, 0.28 versus those ones that are over half a point just to hold equities. So I want to take a look at the dividend yield. I'm sure it has it here. So the dividend yield of this company or this ETF here, if I just take a look here, I'm assuming it's going to be around here. I'd assume it would be about, oh yeah, right there. 5.3% is the trailing yield. 5.4% is the projected yield. So yeah, that's just a summary of all the banks, because in the banks right now, you got Scotiabank at 7% yield, CIBC at around 6%, I believe, and then lots of the other banks are under 5%. So it averages out to that 5.3% that you're getting through this ETF. So this is actually a pretty good or interesting play in my opinion. One holding to own all the Canadian banks, getting over 5% starting yield, paying about 0.25%, a quarter of a point away to have them all together if you don't have a favorite or you just want the diversification. So definitely, an interesting Canadian ETF there that pays you a nice yield. The third ETF here is ticker XRE, and this is the Canadian REIT index. REITs have been getting clobbered over the last year. Overall, we're down 16% in this ETF. Over the last 5 years even, down closer to 20%. With that being said, this ETF in particular plays a very nice dividend given the underlying assets and securities that is held within it, is really known for their cash distributions. So looking at the company here, they have a starting dividend yield right now of trailing 6%, but forward looking at 5.4%. They're getting a pretty nice dividend yield. You also get some pretty good sector exposure here, looking at where they own their assets. About 40% is in retail REITs, 30% is in residential REITs, 17% in industrial, and then only about 5% in office, which is the area that lots of the market's trying to get away of. You can see they're top heavy, much more top heavy than some of the other REITs. Their top 10 positions here are about 80%. So they got Canadian apartment REITs, great business there, 16%. RioCan, which is probably the best retail REIT in Canada, at about 12%, so on and so forth. But this one has also done very well over the last 20 years, going from $10,000 to about $40,000, $50,000. So has definitely outperformed the market. Management fees at 55 basis points. Once again, a bit higher, especially once we get over that half a point, a bit higher than I like to see for an ETF. So you got to take that into consideration as well when considering whether you want to buy this one or not. But definitely a good way to get exposure to the real estate space without necessarily going stock picking, which can get risky in that area. So we talked about the management fees. In terms of risk, whenever a company or an ETF pays a nice starting dividend or a good starting dividend, it tends to limit the risk a bit because you're getting some of that capital out. You're a bit less exposed to capital appreciation of the security, but still heavily reliant on debt, interest rates, and whatnot in this space, which is why this is definitely not a low risk investment. Also 100% equities, which tends to be on the medium to higher side as well. So it's positioned as a medium size risk on this stock here. And in terms of some of the other information that they're sharing here on the overview, you can kind of see their objective here is to just get you exposure to the Canadian real estate the Canadian REIT market essentially through different types of securities and types of real estate. Seeks to provide long-term capital growth by replicating the REIT index net of expenses. The next ETF here is one that I actually own. This is the first one out of the group here that I personally own. It is ZDI, which is the BMO International Dividend ETF. So this company here provides exposure to lots of international stocks that I find hard to get good exposure to in the Canadian market. You can see here over the last 5 years, stocks up about 4%, but they have paid a pretty juicy 4 or 5% dividend over that timeline. In the last year, we're up 13%. We had a bit of a dip because of the war that was taking place around Europe. So the stock dipped from $20 down to about 16 at one point, and now it's kind of rebound back to where it was prior, as the economy didn't get hit as much as investors initially thought, at least. So looking at their growth, you can see here from about 10 years ago, they've grown from $10,000 up to $16,000, $17,000. So pretty nice growth there. When we look at just some more attributes of the fund here, really great to see the geographical diversification of this one. So you can see here 17% from Japan, 16% from France, all the way down. You got United Kingdom, Switzerland, Germany, Australia, Hong Kong, Netherlands, Norway, Denway. They also have more other than that. But you get a sense that I'm getting great exposure from all over the world, where I'd otherwise have a very hard time tapping into these economies just from investing in equities on the TSX. And then from a sector perspective, a lot more diversified than the Canadian economy, being primarily financials and energy. Also have a lot of healthcare in there, like Pfizer, AbbVie, those kinds of companies are mostly European. Industrials, consumer staples, materials. Another thing to note is I also get pretty good presence of United States exposure, both through my stocks on the TSX, but also through my US investments. So I made a point to invest in an international ETF that did not have any US exposure. I'm entirely getting outside of North America exposure by getting this European and Southeast Asia exposure on these stocks. Some of the holdings here, none of which I could get access to in Canada. We got BNP, which is, I believe, a bank, Unilever, Nestle, Novartis, LVMH, Rio Tinto, just great companies from other regions of the world that now I get to own a piece of through this ETF. With that being said, looking at their management fees here, and I was just showing in this chart here the same thing, just how you're getting an opportunity to own some of these stocks. But the management fees on this one are not necessarily low. They're at 0.4%, so definitely better than a couple of the ones we recently just looked at, but still on the higher end of what I personally like to pay as a management fee. And I make a bit of an exception on this one because they're truly providing me with a service or a benefit that I would not be able to get through individual equities without paying FX fees or opening up new brokerages or having a lot of hassle. And I also get a monthly distribution that equates to 4.6% on an annualized basis, which I really like to see that capital get flowing back into my portfolio. The next one here is the iShares World Excluding Canada Index. So this essentially has equities from all over the world except for Canada. So if you have a very heavy TSX portfolio, you only or primarily invest in Canadian stocks, this may be a good opportunity to diversify that portfolio. This would include the US, so I imagine it's very US dominated. See, it's actually done very well over the last 5 years. Once again, probably driven by the US. You can see the performance there. It's pretty much doubled over the last 7-8 years. And they just own different funds. So you can see over 50% of this fund is the S&P 500, which is the biggest 500 companies in the US. And then you're getting some emerging markets. You're getting some small cap, mid cap from around the world. You're getting another US fund in there as well. So you're primarily investing with the US with a couple 20-30% builds of other areas of the world. So just be cautious of that when buying these total world funds or world excluding Canada funds. You're getting a lot of US exposure. If you don't want Canada, but you also don't want the US to diversify, I would consider or look into something a lot more like one of these ETFs here with the ZDI, where you take out the US from the investment as well to get more exposure to those areas that you can't get otherwise. In terms of the dividend yield on this one here, I'm just going to type in dividend. Looking at some other attributes here just quickly. Management fees a bit less, just 0.2%. But I'm trying to get a look at sorry for the sneeze, but the dividend yield. So it is a smaller dividend. That's because it's primarily dominated with S&P 500, which doesn't pay a great dividend. We're getting about a 1.7% dividend yield. This is definitely one of those smaller ones with more developed companies that'll probably grow over time, but not necessarily juicy yield to start with, like ZDI which focuses more on those blue chip dividend stocks. A lot more technology in the S&P 500 that doesn't pay a dividend. The next stock here, and I think this is my second last one, is the BMO Canadian High Dividend Covered Call ETF. So this is another one that I own. You see here in the last year, we're down about 6%. In the last 5 years, down 12%. But covered call ETFs are not necessarily meant or expected to go up over time. You're just selling the upside for more in income today, because the covered call ETF selling premiums on the upside of the equities that it holds. So it's a lot more active for the portfolio managers, which means these covered call ETFs tend to have higher management fees. So something you got to watch out going into these. But they also provide really strong income. So you can see here over the last 6-7 years, this one here has gone from $10,000 up to about $13,000 to $14,000. So very okay returns, let's call it. They are trying to replicate the Canadian economy here with the high dividend paying stocks, or the dividend paying stocks in the Canadian economy. So you can see they have railways, they have energy companies, they have banks, obviously. They have some resource companies, some consumer discretionary companies, and staple companies at the bottom there, but primarily mimics the Canadian economy with heavy financial and energy exposure. And in addition to just getting the dividend yields from lots of these stocks, like TD Bank today has a 5% starting yield. Enbridge has a 7% starting yield. Bell has a 7% starting yield. They also sell the premiums on the upside for people who want to buy options to buy these stocks at higher amounts. And those premiums get added to the dividends, which give the yield of these companies another boost. So I'm just trying to look at the trailing yield if they have it on this chart, but I know what it is from the dividend that I get every month. I'm just trying to see. Looks like they don't have it anywhere I can find it easily, but I know this company pays about an 11-cent a share dividend a month, so about $1.30 a year, and you see it there at $16. So it's paying about an 8.5% dividend yield on the Canadian economy between those high dividends that they get naturally, but then the dividend or the premiums that they get on selling the upside. Choking on my words a bit on this one. But like you saw, the management fee on this one was 0.65, so a bit of a higher management fee. You want to be careful of that when looking at these stocks. And the last dividend or distribution Canadian ETF to consider buying. This is a cash ETF, so you can just hold cash in here, and throughout the month you accumulate high interest that pays you at the end of the month. You know, I was looking at a lot of bond ETFs to share just to get a different option other than equities, but lots of them I just don't think make sense. It's ones like this one here, the BMO Aggregate Bond Index, but this one here pays a dividend yield of close to 2.5–3%. Let's take a look at it here. And I just don't understand in this environment right now why people would be signing up for 2–3% dividends when you can get 5% dividend on cash itself. So annualized distribution of about 3.7% on a 3% average coupon. But you can just take away the risk of the stock fluctuation, go into an ETF like cash, and get a 5.4% starting yield with zero risk. So assuming your objective is to just get a return on your cash, and that's like the end objective of owning a bond ETF, I don't see why, personally, I wouldn't put more money in an ETF like cash, or there's a few other ones like this one, to get that dividend yield than buying a short-term or a long-term bond fund, assuming it's relatively safe bonds, which tend to be yielding under this and paying a higher management fee from what I've seen. So this is one that I just think it's a good place to park money, good replacement for a bond ETF, assuming your objective is just cash flow and you're not trying to play or bet on yields going up or down over the long term. And that's just kind of why I threw this one in instead of those bond ETFs that that I was initially looking for. So these are 7 Canadian ETFs that each have pretty nice dividends. Some of them larger dividends, like the covered call ETF that we went over. Some of them smaller dividends, like one of the growth ETFs or the total world ex Canada ETF, which was dominated by the S&P 500. So it really depends what you're looking for. You can also, introduce a mix of these ETFs if you're looking to build income in your portfolio. Like you can include ZWC for the 8-9% starting dividend yield, and then go into something else like XAW for more of the growth and capital appreciation, and mix and split your investments across many of these if that was something you were interested in getting broad exposure across geographies, across different dividend yields, want some dividend growth, want some stable high yield, mix them all together and you may get a basket of stocks or ETFs that work for you in your portfolio right now. So thank you so much for watching this video. If you like this kind of content, be sure to give this video a big thumbs up. It really does help with the channel, and consider subscribing to the channel as well for more content like this. See you guys in the next one.